You said that you're for a little bit less accommodation near term, possibly. What specific steps, if you could implement, would you have take place in the near future?
I think in the near future, I think it would be appropriate to be changing the forward guidance that's in the FOMC statement. The FOMC statement is currently saying that the FOMC anticipates, expects to be keeping interest rates extraordinarily low through late 2014. I would be bringing that date in to a nearer date than late 2014. I think that would be a useful first step.
About when?
You know, that's obviously a challenging question, but there's a gradualism built into policy. So that is, you don't want to necessarily make big changes in policy. So with that said, I think that you want to be changing that date to something in 2013 as opposed to saying through late 2014.
I'm sorry, did you say 2013 or late 2013?
I said that I would change that date from being through late 2014 into something, through something that was in 2013. For example, in August, the committee had said through mid-2013. I would be more comfortable with that language.
Did the March jobs report temper your view at all on this?
You know, the March jobs report was merely one piece of information. We had seen, I would say, 6 months of pretty good jobs reports, and March was not as strong. With that said, I think March offers a dichotomy that we've been having to deal with for some time now, which is the unemployment rate coming down without necessarily seeing the employment population ratio going up by the same amount, or by a reflective amount. And the committee is going to have to make some judgments as we move forward about what that, if that pattern were to continue, the committee would have to make some judgments about what that means. I think I've been clear myself that in my past statements and speeches that I think of the marker for us on the employment mandate is coming through on the unemployment rate. And so declines in the unemployment rate represent continued progress on the maximum employment mandate.
How concerned are you now that issues in the Eurozone could arise again and cause more market jitters in fact the U.S.?
Yeah, I'm less concerned than I was in November. I think I think the risks of that kind of event have declined, but there's still, that event is still out there as a possibility that there would be financial market strains in Europe that could spill over into our own financial markets, and that would be problematic for our economy, certainly. I think you can tell a story where that was responsible for slow growth in 2011 and responsible for slowness in growth in 2010 as well. So I think it would be an additional challenge for the economy if that were to take place. But as I say, my likelihood, my assessment of the likelihood of that event has declined a lot since the end of last year.
They tried to get you to take a stab at agriculture in the Minnesota economy, and you indicated that it's probably not as big a chunk of the economy as some people might suspect. What role does it play? What portion of the economy is it? And how did the good times of the last few years factor into the general state of the economy in Minnesota?
No, it's certainly a positive. I think it's certainly our roots here in Minnesota. I think we feel very strongly about the connection to agriculture. But this is an economy that's very diverse, and you look at you do the measures in terms of how much production is coming out of agriculture, and it's going to be roughly similar to what it is in the national economy, something on the order of 4% or something like that. I'm not going to get the exact number probably, but You know, it's definitely been a positive to have agriculture doing as well as it has. You know, but I have to say, when I go to other states in the 9th District, South Dakota, for example, in North Dakota, these are states which are much more agrarian in their focus, and you feel much more strongly then as a result.
Can I ask about the exit strategy? You see the exit strategy starting 6 to 9 months, and then rates moving after that. And I wanted to just kind of understand better the mechanics of that, given that it's April now. So then we're talking about the very end of this year. Really, how does that timing work?
Well, the timing of the exit strategy was left, I think, deliberately vague to give the committee flexibility to choose that timing based on conditions. But if you go back to the June 2011 FOMC, I'm going to forget whether it was in the minutes. I think it's in the minutes. At the end of the minutes, there was a consensus statement about the sequencing of the steps involved in exit, and you know that essentially it's there's going to have to be some steps about reserve draining would have to take place first, and then there would be some deliberations about at what point then it would be appropriate to raise rates. But you know, essentially there is the committee made it clear. I took it from that June 2011 statement to make it clear there would be a sequencing of steps, and we would have to initiate that sequencing of steps. And that sequencing of steps is, as I say, going to take place over multiple months and probably into years, because it's going to be a question also about balance sheet reduction eventually. But you know, that's talking multiple years off at this point.
There was one thing that was in the minutes, the discussion about there was discussion about additional methods to communicate there was no action that was planned and no action was taken. Is that, I don't know if I'm asking you to go into the committee room here, but is that something you can talk about, what you think would be appropriate as far as expanding the way that communication is done?
Yeah, I mean, I think the committee has made a number of very good steps in a very short period of time in terms of communication. I think the press conference was great innovation. Really allows through the voice of the chairman to the committee a chance to provide a better color about its decision making. I think that the long run the long run framework statement that came out in January, long run goals and strategy statement that came out in January, another really, I think, useful form of communication in terms of pinning down what does the FOMC thinking about when it tries to implement the mandates that have been given to it by Congress. I think that it would be useful as well to provide maybe more of a consensus view of the arc of future policy. So right now, the FOMC is releasing participants' forecasts for the Fed funds rate 1 year, 2 years, 3 years out, and as well as going along with that. And to be clear, those forecasts are under that particular participant's assessment of appropriate policy. So it's really that's really like a survey where you're asking every participant in the room the question: suppose you were in charge of monetary policy, how would you set the Fed funds rate? I don't think that necessarily is the most as useful way of communicating about the future arc of policy as it would be is that the FOMC had a consensus viewpoint, that like what's being offered in the statement to a certain extent, but to go along with that, a consensus forecast of some kind. So more, I think, as opposed to just surveying participants in the room, I think better having some kind of collective viewpoint that's being offered by the committee would be even more clarity about the evolution of monetary policy.
I just wanted to be clear on something then. when you're talking about the forward guidance statement and changing it from 2014 to something in 2013, is this, how does that work in terms of that versus the sort of the slow steps of sequencing into pulling out? Is this something the FOMC can say in their next meeting, pulling back the guidance statement to 2013? I just wanted as a point of clarification.
Yeah, I would say, so this is a good question. I think the answer, my own answer to that is yes. Remember, I think that the statement would continue to say through mid-2013, at least through mid-2013. So you're offering, to use technical jargon, a lower bound, right? It's sort of a forecast of an early point of when you might raise rates. It leaves open the possibility you might raise rates later than that. So I think those are internally consistent.
So you would definitely rule out moving it forward to something in like the first half of 2013, definitely at least through mid-2013.
That's something I'd be happy to talk about and be interested in thinking about. I mean, I think there's always a danger in moving policy levers too much, too fast. It's you make policy in light of what's been said before, and so it's not like I'm parachuted into the room from nowhere, and we haven't had any kind of conversation before. So with the public in particular. So in some sense, my proposal is undoing what was done in January to take us back to what we were in December. So I think of it as being a relatively modest step.
Okay. Sorry, just to double check it. So you would suggest for now moving it to at least through mid-2013?
That would be my suggestion, yeah.
Well, in your speech, you say sometime 2013 or possibly late 2012.
I do say that, yeah. Yeah, but I did say that.
Can you distinguish between, like, do you mean something different in each of those cases?
So in one case, you're asking me to specifically say what I would do with policy and changing how I would change a statement. In the other case, what I would do if I were in, I thought of that as one of my speeches, suppose I were in charge, kind of describing why so I think of those as being two different questions. But to be clear, I would be open if certainly the sense of the committee was to move the date even earlier than mid-2013. I would certainly be open to that possibility.
So when does the committee meet next?
Later in April.
Do you have any concern about the easy policies, monetary policies right now, encouraging an asset bubble in stocks or commodities?
No, not at this stage. I'm not. I don't see those concerns. I mean, it's. I look at equities in particular. I don't see that those prices seem unduly elevated. What you're looking at is sort of the ratio of prices to earnings and how that compares to the level of interest rates and whether that gap seems large or not, and it doesn't seem large by historical standards. So I guess the short answer is no.
What was your level of surprise at the market's reaction to the minutes? Did you think that was?
Yeah,
I don't really track that closely, I have to say.
Do you have any concern that the rising impact on fuel prices might have a do?
Yeah, oil prices were to go up by more. This puts a strain on the recovery. I wouldn't see any such move as being being likely to introduce permanent movements into inflation. It's more be a drag on the economy that I'd be concerned about. But it's another one of the, as I talked about in my speech, there's many risks to the outlook, and this would be one of them.
A couple more, guys.
When you look at your inflation target as 2.3%, are you taking into or based on forecasting the assumption that the Fed keeps its rates where they are through that in late 2014 that we were talking?
Yeah, so that's not my target. That's my forecast for inflation is 2.3%, and yeah, I'm not. When I offer that forecast, and this is a good question. When I offer that forecast, it's under the presumption that the consensus that I will not be the one making policy on my own.
But is it a presumption that the FOMC policy as it's stated currently upholding until like 2014 will be in place until that point?
It's consistent with the committee's statement that it expects to keep interest rates extraordinarily low through late 2014.
Anybody else? I'll throw one more out. Do you have a response to foreign governments in Asia and Latin America saying loose monetary policy from the Fed pushes up their currencies and causes some trade problems?
Yeah, it's, I guess simple answer is no, not at this time.
Straightforward.